What you're looking at now are two candles. You have the bullish candle and you have the bearish candle. Each of these candles tell a different story. There are two investors in the market. You have the buyers and you have the sellers. Let's start with this bullish candle here to the right. All this means is that the buyers overpowered the sellers and drove the price up. Same concept, but the complete opposite with the bearish candle. The sellers overpowered the buyers and drove the price down. Now, always remember with the bearish candle, price opens at the top and close at the bottom. Again, with the bearish candle, price always opened at the top and closes at the bottom. The opposite goes for the bullish candle. Price opens at the bottom and closes at the top. This area here is the body. We refer to this as the body of the candles. This area is the body. These little stick figures that you see on each candle at the top and the bottom, we refer to those as wicks. These are wicks, pretty much indicating that price opened here, came all the way down, tapped this low area, and it proceeded to make its way up and tap this high area. Then it closed. Same concept. Price opened here, tapped this high area, proceeded all the way down and tapped this low area, and then it closed. Just that simple. Engulfing candlestick. What is an engulfing candlestick? It's pretty much an indication letting us know that a reversal is about to happen. A candlestick in the opposite color of the previous candlestick, and it engulfs it. Now, if we look at the previous candlestick, which is here, pay attention to the entire body. Let's slide over here to the engulfing candlestick. Notice that the engulfing candlestick covers the entire body of the previous candlestick. That's what these yellow lines indicate, right? An engulfing candlestick opens at or is lower than the previous candle and closes above the previous candle opening. Let's get into some examples. All right, if you look closely, we always look at our previous candle, which is here. This big green one is the engulfing candlestick. Notice how it covers the entire body of our previous candlestick here. That's a good indication that price is now heading up. Let's see what happens. We were here. This green candle here was our engulfing candlestick. And look, price soared through the roof. Now let's get into some bearish engulfing candlestick patterns. Here we are. Engulfing candlestick bearish here, right? Look at the previous candlestick, which is here, this green one. Notice that the engulfing candlestick covered the entire body of our previous candle. This is a good indication that now price is heading down. Let's see what happens. We can see here, we were here and look, price headed its way down. Now, this is also very important. Don't let this be the end all be all when you're using candlestick strategies, because a lot of traders, well, rookie traders, they would see this engulfing candlestick and enter the trade here. Now, a lot of times price would end up continuing all the way up instead of going down. So let this be one of your confirmations. I always say have yourself 3 to 4 confirmations when you're entering and executing trades. Let this be one of your confirmations. You want to have other confirmations like support and resistance, trend line strategies, break and retest, and we'll cover all those on the later segment. Multiple candlestick pattern. What is multiple candlestick pattern? It's 3 or more candles that have wicks facing one direction. The more candles, the better. Let's get into it. So we have a candle here, here, and here. And what do they all have in common? They have wicks facing one direction. So let's get into some examples of what this is. So if we look up here, this line we will call a resistance level, and we'll get into what that is later on in the segment. So as you can see, we have 1, 2, 3 candles with wicks facing the same direction. This is a good indication that price is now going to head down. Let's see. As we can see, we were here and price tremendously fell down. Multiple candlestick pattern. Momentum candle. What is a momentum candle? It is a candle that is 2 to 3 times bigger than the previous candle. Let's get into some examples. So from here to here is what we would call a choppy market. In other words, it's consolidating. It is trading sideways. There's very little volume going on from here to here. So the next thing we will have to do is wait till our momentum candle is formed. Let's continue. We can see here our momentum candle has finally formed, and look what happens to price after it's formed. Soars all the way up. Now let's get into a bearish example of what a momentum candle is. Same concept. So from here to here, the market is consolidating. There's very little volume. And look, we have this candle here. Now, I don't know if this candle is 2 to 3 times bigger. It's definitely 2. So we're not going to take the trade here. We will wait to the next candle form, which is here. Now, this is definitely 2 to 3 times bigger than these are. So now we will enter the trade and watch what happens. Price continues to soar all the way down. Just that simple. Momentum candle. The hammer candlestick. What is the hammer candlestick? It's a decent sized candlestick with a very long wick. As we can see here, the body's here and it has the long wick. Let's get into some examples. Okay, so here we have identified our candlestick, which is the hammer candlestick. What happened was price came all the way down here. The sellers was able to get the price here, but a whole bunch of buying pressure came in and surged that price all the way up. The candle ended up closing here. So this is a great indication that the price is now headed upwards. Let's see what happens. As we can see, our hammer candlestick is here, and look what happens to the price. Surges through the roof. Doji candlestick. What is a doji candlestick? A candlestick that indicates which way the market wants to go. So here you have the thin body, and it has a wick on the top and the bottom of the candlestick. Let's get into some examples. So here, the green circle, we have identified our doji candlestick. This whole pattern here is what you would call a downtrend, right? So we're not going to just jump into the market once we form the doji candle. We're going to wait till that second candle forms. Let's slide over here. Now, again, this is our doji candle. The second candle has now formed, giving us an indication that the market is now headed up. And look what happens. Soars all the way up. This yellow line here is a support line, and we'll cover that later on to the segment. Now, before we move on, let's slide over here. There are 4 types of doji candles. You have the regular, you have the long-legged, and then you have the dragonfly, and then you have the gravestone. All of these work the same way. Keep that in mind. The tweezer candlestick. What is the tweezer candlestick? Pretty much both having similar wicks at the bottom. We have a bullish candlestick here, and we have a bearish candlestick here. And look, they both have the same length of wicks. So we're going to give you a bullish example and a bearish example. Let's get into it. So here we have located our tweezer sticks. So now price kind of was consolidating a little bit, and look, and went to resisting right up in here. You see these wicks? They're the same size body and the same length of wick. So this is a good indication that price is now going to head up in the bullish momentum. Let's see what happens. As you can see, we were here, and look, price soared through the roof. Now we're going to give a bearish example of the tweezer candlesticks. Let's get into it. Right here, you can see price was headed up, same length of wicks, same length of body, and price resisted right at this level. So this is a good indication now that price is going to head downwards. Let's see. As you can see, we were here. We had a big push down, and price continued to climb all the way down. Just that simple. Shooting star candlestick. What is the shooting star candlestick? The shooting star candlestick is just like the hammer, but it has a small wick on the other side of the candle. As you can see, we have the body here. We have the large wick and the small wick on the other side. Let's get into some examples. Now, we have located our shooting star, right? This is the shooting star candlestick, and this has the same concept as the hammer. So this is a good indication price is now going to make its way down. Let's see. Here, we have our shooting star candlestick, and we can see price made its way all the way down. Just that simple. Marubozu candle. What is a Marubozu candle? pretty much a large candle with no wicks. As we can see, this is the body. There's no wick at the top or the bottom. Now let's get into some examples. Here, we have identified our Marubozu wick. Pretty much we're already in an uptrend. So this is an indication that price is now going to continue to head up. Before we move forward, I also want to point out the fact that you're always going to find a Marubozu candle in the middle of an uptrend. For example, as you see, this is the middle of an uptrend. Price is continuing to soar up. We have located our Marubozu candle, very large with no wicks at the top or the bottom. Just that simple. And as we can see, here we are. Price has soared up. Now let's give a bearish example of what this does. Here we are. This is our Marubozu candle on the bearish side of things. Let's get into some examples. We have located it here. And this gap here, I know a lot of you are wondering, like, wait a minute, what happened to the candles up in here? So this is on a Friday when the market closed. So price closed off right here. And this is Monday morning when the market opened. So it's why it starts here. I know a lot of y'all are looking confused. I just wanted to point that out. Now, back to the program. This is our Marubozu bearish candle. And look, large with no wicks at the top or the bottom. Let's see what price did. As we can see, price soared all the way down. Just that simple. Okay, moving over to charts. Always remember, the market can only move in 3 directions. Up, down, and sideways. Once again, the market can only move in 3 directions. Up, down, and sideways. This is an uptrend. This is a downtrend. And we call this sideways consolidation. When moving sideways, the market is consolidating. Moving on. What you're currently looking at here is raw data. This is the most important piece of information you are going to need when it comes to your trading journey. This here is what we call a trading chart. And you can access this for free over at www.tradingview.com. This is where I utilize all of my markups, my technical analysis, and all of my trade strategies. Let's dive into the charts. So we look closely right here at the top left where you see the 4 and the H. This indicates we are not trading on the 4-hour time frame. What does that mean? Okay, so if you look at all these candles, every last single one of these candles, it took 4 hours for each of them to open, form, and close. If we look to the top right, this candle we're currently on is trading at $2,716. And the time left on this candle is 3 minutes and 43 seconds. Once this time expires, this candle will close at whatever price level it's at. And then to the right of it will appear and open a brand new candle. And that time will be 4 hours. And it's going to count down again and so on. Just that simple. This is the same concept if we were to be trading on the 15-minute time frame, or even a 30-minute time frame, or even a 1-hour time frame. Whatever time frame you desire, it's the same concept. Now, before we move on, I know a lot of traders tell me all the time, hey, I trade on the 1-hour time frame, and why do you trade on the 4-hour time frame? It's just my preference. Now, true enough, I have made money on the 1-hour time frame, the 15-minute time frame, or even a 30-minute time frame. But I'm able to see confirmations and things on the 4-hour time frame that I don't see on the 15-minute time frame, or the 30-minute time frame, or even the hour time frame. Just my preference. Okay, moving on. If we look to the right of the screen, where you see all these numbers here, these are where your price levels are always located. Always to the right of the screen, your price levels. Let's go to the bottom, down here where you see the numbers and the dates. These are where your dates are located. How do we use this? So for example, if we wanted to do a back test in history on where price has been and where it has went, we would, for example, come here, right? We would come here and we would see that on November 11th, Monday at 2 p.m., the price of gold was trading at $2,674. That's how you utilize that. Real simple. Let's move down to the bottom of the screen. Now, again, remember, my job is to articulate and simplify the message to where you grasp it. I don't want to get you guys lost in the sauce or overwhelm you. So we're only going to cover the icons located at the bottom, the ones that are important. Everything that's not useful or that's not important, we're going to skip right over that. Okay, let's continue. So here, this pencil icon, this is the drawing. You click this and you're able to mark up your charts, like with your break obstruction line, support and resistance, things like trend lines. So you're able to draw up that. Okay, next icon, indicators. What are indicators? Indicators are like moving average lines. Right here, I don't know if you guys can see that. There's a black line and then there's also a blue line, and it kind of like flows with the candlestick. So those are your moving average lines. Okay, the next icon is alert management. How does that work? Okay, you look to the right. The price of gold is trading at $2,716. Obviously, that's high. We want to be able to purchase this asset at a discounted price. So let's say, for example, if we wanted to purchase this asset at $2,515, we would then go back to here, which is alert management. We would type that price in here and the asset name is gold. Once price come down and tap the $2,550 price level, an alert will then notify us through our phone that, okay, the price of gold has touched this price level. And then we're able to either buy, sell, or trade. Just that simple. Now, I know a lot of you have jobs. A lot of you like to vacate and you're with your kids in the afternoon. So I advise you all to look on your app stores, type in TradingView and download this. You're going to need it. This is like the navigation and forecast through the trading world. So go do that, and I'll see y'all over at the next segment.